Hey everybody, how's it going? Welcome to a Capital Hungry Monday Market Update webinar and Trade Ideas webinar as well. I don't know why I said webinar twice, but welcome everybody. Welcome my friends, family members, Capital Hungry members, aristocrats, hyenas, retards. Everybody is welcome here. How's everybody doing this evening? Is the audio and visual good before I jump into it here? Because I want to jump straight into the information, straight into the analysis, trade ideas, and going through our normal process. Yeah, can I get a quick thumbs up in the chat? Everything good? Sound, audio? Okay, perfect. I'm going to jump straight into it then, all right? Let's go into it. So, some recent key fundamental events that have been in focus is of course what we had come up last week, towards the end of last week with the IMF meeting. For those of you who do not know, towards the end of last week there was an IMF meeting with various central bank heads, including Bank of England's Bailey, Euro Central Bank's Christine Lagarde, and of course Federal Reserve's Jerome Powell as the main people of interest there. So what we had happen was the central bankers as a collective brought a lot more uncertainty and doubt to the markets, talking about the risks of rising inflation, geopolitical tensions, supply chain issues, and so forth, and also brought a more aggressive hawkish tone towards interest rate hikes to come in the near-term future. What this did is bring new fear, uncertainty, and doubt, and of course, lead to a correlated market impact of seeing a variety of asset classes have an outflow of liquidity. So anything in terms of an asset class in the market that would be negatively impacted by interest rate hikes, such as gold, oil, stock market, and so forth, had an outflow of liquidity and more downside moves across the board there. And we saw some of our safe haven currencies pick up strength, like the Japanese yen and US dollar. So that's something that we're going to be looking to play into this new weekly period as well. And we can already see from Sunday market open into the Asian session, London overnight in New York, that fear sentiment is holding more weight. Japanese yen continued a bit more bullish as we saw Japanese yen pairs drop off from the highs. Gold still had that deeper drop down into that daily demand zone at the 1890s. Stock markets continued more bearish as well overnight and so forth. US dollar continued with that strength, right? So we can see US dollar bulls still active at new intraday highs. New fear, uncertainty, and doubt via the IMF central banker meeting. Global inflation becoming higher risk. Equity seeing weakness with hawkish central banks in post-IMF meeting. Market sentiment has shifted into the seasonally sell in May and go away with more fear, uncertainty, and doubt. This led to a market sentiment impact of investors pricing in more rate hikes to come in the future, as well as that uncertainty and doubt, keeping safe haven currencies on the intraday timeframes more bullish, such as the US dollar and Japanese yen, and global stock markets being a lot more bearish overall there. Market volume and volatility has also been nice and healthy as we're digging deeper into Q2 for this new year, and we're having those various fundamental catalysts come into play of central bankers transitioning more into a hawkish tone. We are seeing that stronger liquidity with the downside moves on the equity markets, very aggressive moves on our currency pairs like GJ, GU, gold as a precious metal. And of course, we're going to be expecting that volume and volatility to continue to hold some weight. Very nice, healthy conditions in terms of volume and volatility for us to be trading as scalpers and day traders. Now, some key news events here. You can see that Bank of Canada representative is still talking about more aggressive rate hikes with 50 basis point rate hikes potentially for the next meeting. Moody's, which is just obviously your sentiment there. Moody's says inflation risk outweighs benefits for most financial institutions. And we also have some lingering Ukraine and Russia tensions with NATO essentially engaging into a war with Russia through a proxy and arming that proxy, meaning Russia doesn't like NATO sending all of these weapons over to Ukraine, and they're seeing that as NATO's way, like Europe, UK, America, of course, they're seeing that as NATO's way of intervening with this conflict and potentially also escalating it. So we are seeing more fear, uncertainty, and doubt develop in the markets. When we're looking at our global equity markets, even though we had a bit of a bounce just at our New York session, you can see we are very bearish across the board when we're looking at global equities in various regions. Asia Pac, North America, Asia, and Europe overall, all very bearish, seeing an outflow of liquidity with inevitable higher rate hikes to come and more geopolitical uncertainty developing, especially as we're digging into the end of this month and going into the new month of May. When you're looking at our sentiment indicators, even though the volatility index turned a bit more bearish for the day, as equities just had a bit of a bounce from the lows, we can still see dollar very bullish. We can see the Japanese yen creating a bit of a support and consolidation at these lows from 77.5, and the volatility index breaking above significant price sensitivity areas and still potentially relatively bullish here when we're looking at the intraday timeframes. Now, from a fundamental perspective, one thing we want to note about the Japanese yen is, of course, in the short term, the Bank of Japan did not mind having a weak yen as it promotes their international business activity, especially with negative interest rates. But the volatility of how fast the Japanese yen dropped bearish, meaning USD/JPY extending a lot more bullish, was far too aggressive for their liking. Bank of Japan members have also said themselves that they wouldn't look to take any intervention with the currency or look at interest rate hikes until USD/JPY would reach around 130 price point. And they said this a couple of months ago, and UJ recently was just shy of hitting 130 there, where the yen being that weak becomes counterproductive for their international business activity. And it does look like we're coming to price points on the yen in terms of the FX market, where the Bank of Japan will be jumping in, maybe at the next rate meetings, to start looking at raising interest rates. Okay, so we are seeing, even though yen is bearish, failing to break these lows, starting to create a bit of a support in double bottom, VIX holding a lot more strength, dollar still very bullish, of course, pricing in the Fed rate hikes to come in the next meetings, and equity markets a lot more bearish as well, as we're seeing that outflow, again, pricing in 50 basis point rate hikes to come in the next meetings. And of course, the fear, uncertainty, and doubt lingering. Now that we understand those current fundamentals at play, as well as the market sentiment, we just want to go through what economic events we have on the docket that can impact any of these trading instruments that we trade before we jump into some technical analysis and bringing together the fundamentals and technicals to map out some intraday and scalp trade ideas for us to execute on in the coming sessions. So, basically, we are focused in on here. Over the Asian session at 7:30 p.m. Eastern, we have some unemployment rate and jobs data from Japan. Shouldn't have too much market impact. Okay? Durable goods at 8:30 a.m. Eastern for US dollar impact there, US dollar, gold, US economic data. 9 a.m. Eastern Case-Shiller data, 10 a.m. Eastern consumer confidence and new home sales report. Honestly, the durable goods might have some impact on just keeping dollar relatively bullish, as we're expecting stronger economic data there and a recovery from these negative figures. So that will just further support our bullish dollar bias anyways. Then at the Asian session, we have some Australia CPI, which is not too much in focus here unless you trade AUD pairs. Something to look out for with inflation still being high around the world. Now, a lot of people were wondering, hey, if we're seeing an outflow out of equity markets and out of these other asset classes, why is gold bearish as well? Remember, gold is also an asset class that has been very bullish because of low interest rates too, right? So when we're seeing that when we're seeing this global uncertainty developing on top of the Feds talking about aggressive rate hikes to come, you're going to see an outflow out of the majority of asset classes, and you're going to see that on gold as well because you're pricing in those 50 basis point rate hikes to come, where interest rate hikes is a bearish fundamental factor for gold, right? So somebody asked the question, well, if equities are going down, gold is going down, where's all the money going? Remember, money doesn't and liquidity doesn't always have to be actually in the markets. Liquidity can be called, liquidity can also be held on the side, which is called just holding free cash, right? So you don't actually essentially have to be involved in the markets. We're seeing a lot more outflow of liquidity in these asset classes, more short orders in gold, the stock market, oil as well, and other asset classes that have been so bullish on low interest rates and high inflation. And we're seeing more cash being held on the side, especially with US dollar individually being a lot more bullish, right? So it looks like with a lot of the uncertainty developing, these deeper pullbacks being from near all-time high price points, $2,000 an ounce on gold is very historical highs. $100 plus a barrel on crude oil is very historical highs. Stock market are at all-time high price points or where it dropped off from, right? And you can also see that even house prices in real estate are at all-time high, record high price points. So you're just having liquidating of positions, and a lot of the smart money investors, the market makers, the whales, pooling more into some of our safe haven currencies, but also just holding more cash on the side, waiting for more data points and information with a lot of the uncertainty lingering, with of course rate hikes going up. You still have supply chain issues that central bankers were talking about, which is just bullshit. They're just using that as a reason to talk shit to the mainstream media and to the masses. We still have Russia and Ukraine tensions lingering as well, right? So now that we understand that and the fundamentals at play and a lot more fear, uncertainty, and doubt, which we have to understand. I know everybody understands that, hey, if there's market fear, gold should be bullish, but it depends on what fear. This uncertainty and doubt that's developing in the markets is economic uncertainty and doubt regarding raising interest rates, right? Inevitable interest rate hikes that are going to come by the central banks, where they're signaling 50 basis point hikes in the next consecutive meetings, especially for the US Federal Reserve, where they want to normalize rates back to 2.5%, right? So what the market is pricing in, the uncertainty and doubt, is inevitable aggressive rate hikes to come. That's why oil has been more bearish, dropping off from those highs because it's no longer favorable to invest in crude oil barrels at record high price points with raising interest rates. That's why gold had that drop off from that 2,000 handle, because it's no longer favorable to keep pooling into that as you're having raising interest rates. That's why the stock market and equity market had this drop off here from 35,400, because you're of course having raising interest rates and record high prices. Before I continue, does that make sense to everybody? Of why at the same time the stock market and gold is bearish with this uncertainty and doubt? I just want to make sure everybody's following along, understanding the information, and then we'll just jump into our trade ideas and technical analysis. Stay hydrated, everybody. Drink your water. Yeah, I'm fucking sweating too. Okay, now what we're looking to play is the weakness in equities, more strength short-term potentially in the yen, some strength in the dollar as well, on top of some of these economic data that's going to be coming in the next sessions. Now, when we're looking at gold, we've had very strong aggressive downside moves. But I want to show you guys something very, very interesting in terms of some repetition here that we could potentially see or that we were starting to break now finally, right? So look at here where we had this previous impulsive move and correction. A lot of people ask, how come gold just doesn't continue bullish? Why do we have some of these equal corrections and so forth? And it's mainly because of, you have to understand that gold is a global precious metal that is not just dictated based on day trading liquidity. It has big impact from miners, from supply and demand, shipping of gold, jewelry, gold that's used in electronics, the hoarding of gold by central banks and how central banks suppress gold price, government hoarding of gold, and so forth. So there's a lot more fundamental factors in play than just day traders trading gold trying to make a profit. You have to understand it's a global economic pillar, right? But anyways, what we can see previously happened here, and we might even see happening here, we have to be very, very cautious, is after we had this significant impulsive move in correction, but still maintained higher time frame bullish market structure and the integrity of buyers in play, you can see as we had this upside move correction, we start to respect very key demand zones, which I was watching from 1920s first flat candle body, but more in this area around the 1880s, 1890s, where in this situation it was around your 1750s, 1760s. From this demand zone, you can see to the left, you have buyers extend up, printing higher highs, and each of the very aggressive pullback phases that sweep buyers out of the market come down to that demand zone essentially, fail to break, and still see more buy orders collected in the market, seeing some continued upside moves there, right? When you're looking at this type of technical and fundamental repetition, you can see something very, very similar here, where once we reach that demand zone, we were having buyers consistently print higher highs and having pullback phases to this exact same demand zone low, where if you fail to break this area here at the 1880s, you can have very aggressive bounces and buy orders being collected and potential upside moves. So what I want to anticipate was, yes, of course, the 50 basis point rate hike signals and from the IMF meeting last week, it had this huge downside impact. But do we have enough seller order flow to start breaking below this very key buyer's demand zone where we failed to break this area since February so far, right? For us to really see any further safer sells, we would really need to see technical breaks below the 1880s and 1890s, which shows me that that interest rate sentiment is holding a lot more weight. And we confirm with the technical breaks below that there's a lot more seller order flow in the market and buyers liquidating positions. Otherwise, we have to be very cautious, as I still see some downside into this area, but we have to be very cautious of how we react at the 1880s. Okay, so now that's just the daily time frame. Right now, we don't just want to start guessing a bottom. We don't just want to start saying, oh, I hope we bounce from here and gold bounces. No, right now we're bearish. Very bearish price action, very bearish breaks below this previous price sensitivity area. And I can at least see us digging into the 1880s still before seeing any potential bounce or upside move. The 1890s and the 1880s here, okay? But I just want everybody on the higher time frame to be very mindful as we're digging into that price sensitivity area and demand zone where we've had very aggressive rejections before sellers fail to break lower and buy orders collected in that area. Does that make sense for everybody? Right? So on the intraday time frames though, we're still far too bearish. So this is what I see on some gold trade ideas on the intraday time frames. What can we see on the intraday? Well, from this 2000 price point of interest, when we had the IMF meeting at the end of last week, we had sellers come into play and start printing significant lower lows. There we go. We had sellers come into play, start printing significant lower lows, and creating this stronger bearish price action and market structure, breaking below these previous key price sensitivity areas to the left, with us just sitting on this previous support roughly around the 1900s there. You can see as sellers print these significant lows on gold, it's very normal to see some pullback phases that can be relatively short-lived go to retest structure before continuing back down again, where these pullbacks and retests to go collect more sell orders can be moves that are hundreds of pips there, right? So what we can potentially see is two things. Either just continuation sells back below 1897 and 1890s here to revisit 1883, then watch 1883 as a make or break area, or I see these trade ideas. Okay? If we break back above 1902, I would see gold entering a pullback phase in the short term, very similar to this situation here, where you had very aggressive downside moves and sellers in play. You start to get some signs of exhaustion and failure to break that previous low, and you have these significant pullback phases, which even though gold is bearish in structure and price action, you clearly don't want to be selling when it's in this pullback phase, because these pullbacks can be 150, 200 pips there and still be respecting overall bearish market structure and price action. But if you can start to notice some exhaustion at the lows and failure to break lower and breaks above secondary key levels, you can easily take advantage of some short-term pullbacks as we go to retest better sell areas before continuing bearish again, right? So all I'm trying to validate is two things now at these new intraday lows printed and previous support to the left there. Do we have enough seller volume and volatility where we're just going to continue down and have our continuation sells? Or are we going to have a short-term pullback phase, retest of previous price sensitivity areas, and then the continuation sells back to the downside? If we fail to break around 1897 and come above 1902, I would see sellers liquidating some positions in the short term, buyers jumping in to relieve them out of the market, creating that short-term pullback phase, which I would expect to revisit this order block in price sensitivity area to the left, collect more sell orders before continuing right back down. So these are the trade ideas I see on gold. Only short-term pullback buys above 1902. Now, from a psychological perspective, you have to understand if you're playing the potential gold pullback and we don't break the overall bearish market structure, you have to understand your counter trend trading and that your pullback in buys are going to be short-lived, so you don't want to marry that bias. You have to mentally adjust that you're taking a counter trend trade as a scalp or day trade. You have to adjust to that accordingly. Meaning, if something happens where you start to get the pullback and then the next hourly candle instantly drops back bearish and starts to continue back down, you can't be angry because the pullback happened and it was short-lived as you're just having more sell orders in the market. For example here, let's say you take some of the pullback buys here because you notice the exhaustion at 1939 and you buy above 45. Sure, you're in profit, but you can see sellers jump in just as fast with the overall structure and bearish price action after collecting more sell orders from that better price point, and then you continue back with the trend. The pullbacks or corrective phases, as you see a pullback in consolidation here, are always very short-lived compared to the impulsive moves back with trend. So it's not like I'm seeing buys back to 2000 from here. I would just see some potential short-term pullback buys if we came above 1902, but I would start watching these price sensitivity areas then back for the sells. Green box being pullback buys, red boxes being where I start looking for sells again. Or if we don't get any pullback phase and we just have more seller volume in the market, we're going to validate that with just the sells below 97, the sells below 1890, and I expect us to revisit 1883 and 1880. Okay? So either we're going to have two things. A short-lived pullback phase just to go and get collect more sell orders and continue back down, or we could just have continuation moves, because we could always have a situation just like this where we could have a bit of exhaustion, sell orders collected, and just continue right back down. So all I'm trying to anticipate at this new low being printed is, are we going to have repetition like this, where we have the low printed and just the continuation down? Or are we going to have repetition like this, where we have a pullback phase before continuing down? Does that make sense for everybody? Is that easy to follow along? Understandable, right? I'm pretty much looking at if we're going to have this sequence of events or just this sequence of events, where sequence 1 would be pullback, then down. Sequence 2 would just be continue down bearish to 1880s. And just take the sells below a 97 and 90, right? So based on price action, that's how we're going to observe. Are we getting that pullback phase, or are we just having more sellers in the market and continuation down? Okay, I'm glad everybody understands that crystal clear. Perfect. That is the gold analysis. And one more thing. If we have the sells play out and we make our way down into the 1880s, you have to watch out for that higher time frame zone we will be digging into there, right? So you can see all this price sensitivity there to the left into the 1880s that you'd be digging into, right? So I can see us digging deeper into there. But as we dig into that zone, in demand zone on the daily and weekly, we do have to be very cautious. So I could still see us potentially digging into here, but we have to be very cautious. Okay? All of these white lines are not based on recent zones. They're based on higher time frame historical price points of interest. So price points of interest historically, where you've seen a lot of reaction on the monthly, quarterly, and yearly time frames. All right, everybody. So if gold makes sense there, I'm going to go on to GBP JPY now. Okay, GJ. We saw some very aggressive profit taking from these highs on GBP JPY. Why did we see that? Of course, from the IMF meeting, a lot more fear, uncertainty, and doubt being brought into the markets. This led to some more aggressive profit taking on the UK equity markets here, which shows us less investor confidence in the UK equity markets, right? At the same time, we had Japanese yen double bottom and bounce from these lows. Now, the Japanese yen is in a little bit of an intraday range. Okay? What we can expect to see is the same time USD JPY price has reached 130 is also the same time Bank of Japan said they would have some intervention and potentially start to look at interest rate hikes. We're seeing Bank of Japan interest rate hikes in the near future, as well as more fear, uncertainty, and doubt, and liquidating of positions in the UK equity markets being priced in here. On the intraday time frames, And also, we could easily see GJ come back to like 160 as we watch these price sensitivity areas of interest and still be very bullish on the higher time frames. Do you guys want me to show you a cheat code on the monthly right now in terms of some technical repetition I can see take place? Do you guys want me to show you a cheat code or no? I'll even color code it for all of you. Yes or no in the chat, quick. Unless you guys just want me to continue with the trade ideas, you don't want to see the higher time frame. Okay, so look at this, right? I always show you guys the technical and fundamental repetition. Look at this very strong buyer demand zone that's never been broken. Then you break out of this corrective bearish market structure. Then you have a very large bullish rally after that and extensions to the upside. Simple enough? Now, look at this technical repetition. Here, from the 2013 run, you can see you have a very large consolidation zone, an order block being created after an extended bullish rally with very minimal pullback phase, with very minimal consolidation phases, right? What you see happen here at this order block and consolidation zone is a very nice bullish breakout and extension up. But you can see the following monthly periods end up doing a pullback, revisiting that order block and demand zone, collecting more buy orders before continuing bullish again. Doesn't this technically and fundamentally look very similar to this now? Right? So I want everybody to look at this right here, everything in this pink box, and potentially what we can see happen in this pink box. As we have more fear, uncertainty, and doubt developing in the short term, Ukraine and Russia tension still lingering, this potential technical and historical repetition taking place, Bank of Japan rate hikes to come, GJ could easily come back to 155, 158 here, just like it did here, retest those order block highs, and still continue back bullish on the higher time frames. So now let's zoom in even more. Right? So again, order block here. You can see the respect to the order block highs and lows. You eventually have a beautiful, beautiful breakout, 3 months of bullish rally until new highs are peaked. Then that following month, this was obviously starting to lead into Brexit coming into the scene, bringing some fear, uncertainty, and doubt, but not full-blown Brexit yet. You have a very aggressive downside move in profit taking that goes to retest that order block high, institutionally collect a lot more buy orders in the market before continuing right back up. I say consolidations as order blocks. I see that as order collection and price sensitivity areas to revisit. I don't give a fuck what old man ICT says an order block is. Consolidation, range, order block, suck my dick. It's just terminology for me describing this. You want to follow along and understand the fundamentals. I don't give a fuck about FVG, order blocks that ICT says, or some next guys that make up fancy words. It's order build. Clearly you're having order build up here. All right. Now, similar idea, collecting buy orders from that price sensitivity area and having a very nice bullish rally to the upside. It wouldn't be out of the ordinary for us to come revisit these price sensitivity areas, collect more buy orders institutionally from that demand zone before continuing back up. Order blocks is the last up and down candle. Then where's the block, buddy? I see a big ass block right here. I see a big ass block here. I'm going to call these order blocks. Buys back then did last long. This is the monthly chart. They went back up to 190. All right, so now, anyways, let's go back to the intraday time frames. So we can see a break of that bullish structure, more bearish structure developing as well, and yen still holding some strength. Don't mind this. We're just going based on price sensitivity areas of interest. Now, if GJ still has pullbacks to these intraday high points and fails to break, I still expect us to have sellers in play and continue revisiting these lower lows that are being printed as we're having that uncertainty and doubt being priced in, as well as Japanese yen rate hikes, and yen is holding more strength on the intraday time frames. So I'd be looking for pullbacks to 0.500 sells, breaks below 163 sells, breaks below 162.5 sells. Now, what I want you guys to understand and look at is very similar to the bullish run to the left. Our reactions are in similar areas where we get some consolidation zones, pullback phases, or order blocks being created there, right? You can see as we are making our way to the upside, we had these minor pullback and corrective phases. The same time we're reacting at those same type of zones and price sensitivity areas there. Right? So now we can also see the expectation of mirroring this move and continuing the bearish market structure and revisiting these lows, especially if we see that outflow in UK equities, looks pretty evident as we still maintain this intraday bearish market structure. So I could not jump back into a buy bias unless we were back above 164 or come down to deeper demand zone lows. Otherwise, 163.5, 163 break below, 162.5. I'm still looking for sells with the target points of these previous lows printed and created by sellers in play there. This just being a short-lived pullback as we have some profit taking by the sellers. Buyers provide them that exit liquidity, pushing price up to a more favorable sell zone to collect more orders before driving back down again with the current fundamentals at play. Does that make sense for GBP JPY analysis, everybody, before I go on to our dollar pairs? Does GJ make sense, everybody, before I jump into our dollar pairs? Let me know. Yeah, I'm glistening a little bit. I shouldn't have worn a hoodie. Okay, thank you. Perfect. Now, the US dollar is still very bullish, trending extremely bullish on the higher time frames and intraday time frames. We have smart money, market makers, whales, whatever lingo you want to call it. Oh no, this guy said whale. You don't know what a whale is. Whatever lingo you want to use, the market makers, the smart money, the algos, the institutions, they're pricing in the interest rate hikes to come by the Feds, 50 basis point hikes in consecutive meetings. This is keeping dollar more bullish, especially as a global, as the global reserve currency and safe haven currency, as we have more uncertainty and doubt lingering. So we can see that this led to our dollar bullish bias from last week, and of course, a lot more downside on GBPUSD, EURUSD, and upside on USDCAD. So what we've seen take place is exactly what I've been showing you guys on the higher time frame of this bearish market structure being respected intact, sellers consistently printing lower lows, only having short-term pullback phases and continuing back to the downside. Very nice break below these previous lows. Very nice bearish price action. Dollar still strong, seeing an outflow out of UK and Euro equity markets. GBPUSD and EURUSD analysis is going to be very similar. Now, As we're starting to consolidate at the lows, it's very normal we can enter some deeper potential pullback phases. If we were to break above 1.1275, you could take some potential corrective pullback buys to revisit previous lows here and look for sells at 1.280 or 1.282. But we would need to break above this intraday range in historical level 275. Otherwise, I just see continuation sells and breaks below 26900 sells. I still want to play the dollar strength, the fear sentiment holding weight, the outflow of liquidity in the equity markets, the bearish price action and market structure. Only would see a short-lived pullback to retest these better sell areas of interest, where I'd be watching 2.8 first or 2.82 for deeper pullback sells, just based more on the intraday price action of previous lows printed, or just some of the continuation downside moves. EURUSD, not much different there. We were watching that lower time frame structure. No real reason to even take any pullback buys on EURUSD. I'd be looking for 1.079 retest, break back below previous lows, or just retest of 1.073, continuation sells. ECB is still in negative rates. US dollar is still very bullish. Outflow on euro equities. A lot of sell orders collected in this price sensitivity area that drove us into lower lows. No signs of support being created. No signs of exhaustion or pullback yet. Very strong bearish price action and bearish structure, especially breaking these previous lows. Now, if we're expecting some short-term downside on GBPUSD because of the dominance of the US dollar as the world reserve currency and some downside on EURUSD, then on something like USDCAD, we're more expecting the inverse. You can see from these lows, after having a pullback phase, coming back down to the same demand zone, failing to break, collecting a lot more buy orders, we're having very nice bullish price action and bullish market structure being created with intraday higher highs being printed by buyers. We have a nice double whammy to take advantage of on USDCAD from a fundamental perspective, because obviously with the Canadian dollar correlation to oil, as crude oil dropped like $6 a barrel from its highs, we're having those bears in play on oil, which keeps the Canadian dollar a bit weaker as well. The same time we have a hawkish Federal Reserve and individual dollar strength. I'm personally looking for pullbacks to 2.7, breaks above current highs, 2.76 buys on USDCAD. Even deeper pullback phases to the previous intraday highs here and medium-term zone at 2.66 would still be very, very bullish, as that pullback would be just roughly 50% correction of this very strong buyer's impulsive move, playing that dollar strength. Last but not least, US 30 equity markets here. Now, I can see equity markets digging deeper into these lows printed on the higher time frames at 32,400. Just because we had that bit of an aggressive bounce from that dip there, the bearish price action is still very, very much intact. We don't want to get caught in something like this here, where you just have one daily bullish candle that was just a minor pullback, very short-lived, and don't have full confirms of seller's exhaustion just yet. You can see a similar situation with this downside run as well, where here, as you had very aggressive bearish candles, you had one huge bullish engulfing daily candle, which can really fake a lot of traders out that buyers are back in play, or it's a rejection. It doesn't break the bearish structure or price action, and you still dig down way deeper before getting any signs of exhaustion there. So I'm really just seeing this as a minor pullback some sellers liquidating some positions there, buyers trying to grab the dip and save as much face as they can. But as long as this uncertainty and doubt is still lingering, and we have the rate hikes being further priced in and more hawkish remarks from Fed speakers, I'm still bearish here on the equity markets. Pullbacks to 34,300, which is retest of these previous lows to the left, and that daily low, that daily bearish candle body there. Scaling back below 34K sells, 33,800 sells. Want to revisit these lows. Safer sells below 33,500. For me to really see market optimism back in play, I would need to see yen turn completely bearish on the higher time frames and break these lows. Dollars be a bit more bearish. VIX completely correct this move, and equity markets have a rebound globally. Otherwise, this is just looking like a short-lived cat bounce on the equity markets, as we just were pricing in so much downside with those rate hikes previously. Okay? So everybody, we went through key fundamental points impacting the market, market sentiment, volume and volatility reading, key news headlines, economic events on the docket, technical and fundamental analysis across the pairs, and some intraday trade ideas laid out across the board. Everybody have a great day. Have a great evening. I'll see you all on Roger's streams whenever I'm there, and also on the next New York scalping session. Make sure you guys check out some of the recent webinars I posted. They're Netflix quality mini movies on aggression, Ukraine and Russia, other stuff as well. And I'm going to be posting a teaser soon on willpower. Maybe right after this, I'm posting a teaser soon, maybe in the evening, all right? So everybody take care. Thank you, friends. See you later. Have a great day.